So I'm here with James Hasselle from Mortgage Choice. James, you're the biggest Mortgage Choice business owner in Australia. So I'm guessing you know a lot about the mortgage market.
We try our best, Joe. We try our very, very best.
So tell us, what is the current mortgage market like for borrowers? Obviously, you know, the banks are being very competitive to hold on to borrowers. What's the market like for
the market for borrowers? So what you're talking about there, Joe, is the refinance market, right? So that's the banks trying to retain their clients. So they're all trying very, very hard to retain their clients because they're finding their book, their loan book is dropping off quite quickly. So the runoff, the term is called runoff. So you're finding a lot of the big banks are really fighting aggressively to hold their clients. But there are a lot of smaller lenders, a lot of the mutuals, a lot of sort of names like GSB and lenders like that aren't as big, obviously, as these big 4 or 5, but they are taking market share. And even when you say big 4 or 5, you look at some of the big banks, Macquarie now sit just behind the big 4, but are very, very competitive. So it's a challenging market for those guys. And you're finding they're now trying to focus some digital lending. So they're taking the cream off at the top, straightforward stuff they're trying to sell directly online. Whereas a lot of the broker market now, 70%, over 70%. So 7 out of 10 people go to a broker. So if you're going direct to a bank, you're in a minority.
And what are some of the things that the banks and the alternative lenders are doing to try and retain customers and retain share?
Well, we've had some interesting ones. We review the clients every year and then contact the bank and price it. So we want a better rate. We need to get a better rate for this client. And we've had them come back and say, we'll do X. Then we put a discharge request in because it's not good enough. It's not a good enough rate. And they've dropped again. So it's quite challenging. You've really got to know your market and you've really got to be quite confident in your negotiation.
It's just a shame that the banks wait until they get that discharge request to put their best offer forward.
It's poor. It's very, very poor. If you know what the interest rate should be and you know what the new rates are, so people coming in the front door, new clients, if you know what that is, that's your bargaining chip. You've got to be able to negotiate with that stuff.
And what's the current rate range for, say, investors versus owner-occs at the moment?
Look, some owner-occupied, you're still getting some late 5s, generally into the early 6s, and investment, you're in the mid-6s.
So cost of financing is going to be around the mid-6s in the short to medium term?
In those investor-type loans, yeah.
So we're also seeing a huge trend towards more investor loans. In fact, I think there's about 18% increase in investor loans versus owner-occ. Is this a trend that you're seeing in your business?
Absolutely. And there's a reason for it, Joe, right? There's a reason why there is more investor lending happening, and it's the vacancy rates. Because in COVID, what happened, a lot of investment properties got turned into owner-occupied properties, okay? And now there is a shortage of rental homes. Just today, there were figures out on the Gold Coast, we're just over 1% vacancy. What does that mean, 1% vacancy? It means somebody moves out of a house, there's probably 1 day, maybe 2, and there's a new tenant in. That is an extremely hot rental market. So we need more stock for rental. So realistically, people should, look at that side.
Yeah, and I think, in real estate terms, anything under 2% vacancy rate is considered dire.
Yeah.
So I think, the other thing that's really appealing to investors is the capital growth forecast, particularly in the regionals, regional Queensland and, the Gold Coast. Obviously, I'm biased on the Gold Coast. It's supply and demand that is pushing the growth. Vacancy rate really helps the yield. And
makes a massive difference.
And obviously, with a reduction coming, with an interest rate drop forecast.
It's just when, Joe?
The cost of financing is looking likely to come down, so that's appealing for investors as well. Certainly, from what I'm seeing in the market, there are a lot of investors who are looking up to 750 or $1 million, and we are buying quite successfully on a 5% yield.
Right.
And that, the low vacancy rate is a huge draw card, but it's the rental growth as well as the capital growth that is funding the acquisition.
It's big encouragement when you know you're going to have it rented. I mean, when banks are assessing it, I don't know if you'd realise this, a lot of them are only allowing 70% of rent, right? 70% of the rent because of vacancy and then because of rental costs. It's been nowhere near that for a long, long time. So when you look at that side, it's very, very tempting and encouraging to look at investment properties. And certainly you look here on the Gold Coast, the potential is absolutely massive. So it's a safe investment because it's solid, it's bricks and mortar, and you know that you can get it rented.
The Gold Coast, along with the other regionals in Queensland, is certainly a very appealing market for investors.
Who wouldn't want to live here? You know what I mean? It's you look at the city it's becoming. You've got the infrastructure spend. You've got a massive amount of restaurants. You've got schools. You've got hospitals. It's a different place to what it was when I moved here 20 years ago.
It certainly is. I mean, the key fundamentals driving the Gold Coast market are infrastructure spending. You know, there's $63 billion worth of infrastructure projects planned or underway in this part of the world. Southern migration, interstate and international migration, 33,000 new residents every year.
Which is huge.
Unemployment rate is half the national average. The economic forecast growth is double the national average, and there simply isn't enough houses for the number of residents that are moving here. So that is all very, very positive for investors, along with that low vacancy rate.
For this area, it's very, very good.
Very appealing for investors.
Yeah.
So James, we've just had the annual budget, and there was a surplus in the budget this year. What was in the budget for property investors who are looking at coming into the market?
Look, there wasn't a huge amount in there for property investors, right? But there's a thing that your listeners have got to understand is the media is so sensationalist at the moment. Like they sensationalize absolutely everything, and they talked about it being an inflationary budget, right? But the reality is the big spend item was $300 to every business, every person, rich, poor, or everybody on their power bill. What that does is help inflation for this quarter. So what does that do in itself, right? Inflation being a bit lower is going to help mortgage holders in the long run because it means that the rate decision will be down. So everybody's got to watch those key milestones, Joe, right? We've got to be considering the monthly CPI at the end of May. We've then got to be considering the job numbers, which today went up, which I'm not saying it's a good thing there's more unemployment, but a hot labour market with increasing wages is a problem for the RBA, right? And the big quarter is going to be come the June quarter figures for CPI. What rate should they be with? Where are they aiming for, Joe? 2 to 3%, right? Mm-hmm. That 2 to 3%, 5 years ago, if you'd asked the general public what's the band the Reserve Bank looks for, nobody would know. You could go to a pub now and you could ask anybody and they'll tell you 2 to 3%.
Yeah.
It's just now known in the Australian public that's where they're aiming for. Well, the media blew up something rotten because it was, instead of being 3.4, it was 3.6, right? It doesn't go down in a beautifully clean line. Let's be realistic. But the media did the job for the governor by blowing it up something chronic and having, the next rate could be up and all this fear. And they maintain the fear and it stops a bit of that spending and everything else. So it's the media's doing the job for Michelle Bullock at times.
Yes. And everybody seems to have a different view on when the rate cut will come. We've had rates on hold since November last year. And there was a view that we would get a rate cut in 2025 once inflation came down to within the target range. So we're at 3.6% now.
Yeah.
NAB came out 2 days ago and said they are predicting a rate cut in November. Okay. There's obviously a lot of adverse views to that as well. What's your view on when the rate cut will come?
The Economist come out today and said 50-50. It's 50-50 by the end of the year. And I would say I would be in that same boat. I'd say it's a 50-50 chance by the end of the year we should get a rate drop. I think the inflation is going to continue to come down. I think this budget with the reducing electricity costs is going to assist a bit as well. But what you're going to see is people are not spending as much. People are worrying about, I'll give you an example. I was actually talking to a client the other day and they've said, I've stopped buying my dishwasher tablets at Woolies. And I was like, right, okay. And he goes, they're $50 or $60. I can go to Bunnings and get the same make, my finished dishwasher tablets for $20. So people are thinking. They're thinking differently. And while people are doing that, that inflation is going to come down. There's a good tip for your listeners as well.
Yeah, thank you.
You want some cheap dishwasher tablets?
Go to
you know where to
Bunnings.
go.
And obviously when interest rates drop, there will be an impact on the property market. And I think there'll be an increase in serviceability. People will be able to be a little bit more aggressive on price and what they're able to bid it at auction. And I think that will have a positive impact on the property market. And I think the property market will jump again once we get that interest rate reduction.
If I was a property owner now, which I am, but if I was considering selling, right, you don't wait for the rest to jump on with the rest of the bandwagon when those rates drop. You do it now. Like if you want to list, get that property on now and get it listed because there's still low vacancy rates. Once you get a flood of properties on, it's harder. There's more choice, right? They're going to pick your property apart more. Whereas if you list now, it's going to give you a lot more options.
Yeah. And from a buyer perspective, that impact, the impact of low interest rates will mean that they've got more money to spend. They can, the cost of finance will be reduced. They can be a little bit more bullish on price. And I think what will happen is there'll be a lot more confidence in the market and more buyers will come into the market. At the moment, we're still seeing more buyers than sellers, more buyers for fewer listings. So I think it will increase the competition for those properties once we do get a rate cut and there's more confidence in the market. What else do you see happening for borrowers when we get that interest rate cut from a market perspective when they're buying property?
From a market perspective, I think they're going to have to be very, very careful of their lender choices, right? Market's perspective is, are the rates going to drop evenly across all of the lenders, right? Market perspective is no, they're not. They're going to try and sneak margin and then try and maintain a little bit more profit in each of those lenders. So you've got to be on it. If it drops by 0.25, I nearly guarantee they will not drop by the same amount if you've got existing lending. So lending market, you've got to be all over it. You've got to be all over it and making sure you know what it's gone down by. And if they're not doing that, then you need to be looking around. Market-wise, people have got to be pre-approved, ready to go. The other thing that we talked about in recent weeks, Joe, was bridging, right? Bridging products. So if you've got a property, we've talked about rental rates, right? You can't get a place. So if you want to make that next move, you don't know that you can get a rental. You don't know that there's enough stock to buy your new place. And then when you do see the new place, you're then worried about selling yours. Well, there are products now that can be approved in about 24 hours. If you've got the equity to buy the new place, roll the payments for 6 to 12 months, and then you've got your property to be sold.
And certainly, I'm seeing that a lot at the moment. People who are too nervous to buy before they sell.
But they don't want to be homeless, do they?
They don't want to be homeless. That's right. So, and it is tricky trying to sell a property and then buy at the same time and have simultaneous settlement. That's obviously property nirvana. But
you might address it in things as well. Hey? Like you want to make the property look as good as it can look to sell it. And if you're living in it with all of your 20 years of life, it probably isn't going to get as well as if it's cleared out and you do your staging, which I think you know pretty well.
Yeah, so we have a vendor advocacy service which I'm working on with a client at the moment who needs to sell before they buy, before we buy for them. So we are preparing their home for sale, managing the sale of that property whilst we're looking for the property that they will move into. So it is a bit of a tricky process, and it is I'm working with my trusted agents to get that property sold and to get the optimum price for that property, whilst we then transition them into their next property.
Yeah, so it's a different angle of looking at it. So there are new products now that are out that are just specialist bridging products. So they're not like from banks, they're from insurance companies, right? And it's just specifically for bridging like this. It doesn't matter if there's no mortgage at the end. It's just about being able to get that house now while you do what you're talking about right now.
And bridging finance has traditionally been tricky and complicated and expensive. So how are these new products?
These new products, they charge a fee, which they then capitalise, and they capitalise the payments. So they give two options. You can have it for 6 months or you can have it for 12 months. And that needs to be guided by probably you, maybe the real estate agent. How long is it going to actually take to sell the property? But in my view, I've seen some more senior people that have had a home for a long time, right? With new furniture, with a paint job, with small sort of low-key renovations, they're going to make 100, 200, 300,000 more, potentially even higher. But they can't do it when they're living in there. So this allows them to find that next place, move on, go to their next place, while then somebody like you focuses on getting the best for their property. So it's a ticks all the boxes, really.
Yes, absolutely. And you know, there's perhaps a 10 to 20% upside in, you know, staging a property versus selling it as is. Yeah. You know, case in point, the property that I'm helping
10 to 20% is huge, Joe.
Prepare for sale at the moment. Yeah. You know, it shows pretty badly in its current form.
Yep.
And you know, the agents that I'm working with on it have guided about 1.4. But if we spend $60,000 and stage it and tidy up the gardens and paint it and new carpets, you know, we're looking at a potential sale price of 1.75. So certainly it is worthwhile going through the exercise of the owners moving out and staging it and selling it properly, and then getting that extra jump in price.
What a vast difference, and what a great advantage it is for the customer.
Huge
difference.
And then that obviously makes a huge impact on what they're able to then buy to replace the home.
There was one we were going to talk about, which is the actual borrowing potential in this current market. So there are two sets of lending rules, right? One is governed by APRA and for deposit-taking institutions. So those guys are governed by certain rules. So if you consider the rates we've just talked about, they're putting 3% on top of it. It's a very, very big buffer. That means they're over 10%, some of these. Some of the servicing rates, they're saying you've got to prove you can borrow at 10%. The reality is we're at the top, very, very close to the top of that rate cycle, right? So there are non-deposit taking institutions that don't have to have these same servicing rules. So it can make a massive difference. The rates are comparable, cheaper, or the same as those big banks, but their actual servicing, what you can borrow, can be in the hundreds of thousands more. So it's so important that you actually look outside and look at the whole range of people that's there.
We've spoken a lot about what the RBA is looking for to reduce rates. What are some of the factors that might impact a rate increase? Like, what would have to happen in the economy for the RBA to increase rates?
CPI would have to start racing again. So the consumer price index, which is the breadbasket of all of these different items, fuel, food, insurance, all rents, mortgages, all of that side, all of your costs that the general public deal with are measured. If that starts rising up again, they will not hesitate. They will make that decision and it will go up. So that's why I always watch these figures very, very carefully.
And another big one would be unemployment. So if unemployment was to drop...
If unemployment drops and the labour market races and then there's wage pressure, that also is a thing that doesn't help the RBA. But the RBA will purely work off that CPI, but they have the access to a suite of different economic data that allows them to actually make those decisions. There's less decisions this year as well. So the new set of the board is less decisions over the year, but they have more time to make the decision. Used to be one day, and they also have a robust open press conference afterwards, which they never had, right? So it's much more open way of doing it. They've got 2 days to make the decision, and then they come out and explain why they've made that decision. So it's different to how it was over the past 20 odd years.
Great, awesome. Thank you so much for your time. It's been a really great session. Always great to catch up with you.
And you, Joe, thanks for inviting us.
Thank you.